Andre Kading from Stockbridge. Are government bonds risk-free?
Well, generally they're deemed risk-free because they're backed by the full faith and credit of the federal government. So most investors feel that their money's pretty safe and the U.S. government's not going to default.
Right, free from default risk.
Correct.
Right.
Although, as we've seen in the past couple of years, when we faced a government shutdown, there has been some questions as to whether or not the government could possibly default on some of their payments. So you've
especially
seen
the
interest rates
ultra
spike
short
up in
term.
the short term.
Yeah, when you have all those debt ceiling debates and everything.
Right.
With interest rates having remained in the cellar for what seems like an eternity, what do you think the biggest risks are with investing in government bonds?
I'd have to say interest rate risk, because what you're facing now is what we expect in early mid 2015. The best we can make out right now from the Fed's comments is for them to raise interest rates, and when that happens, the effect on bonds is going to be for prices to come down because of the inverse relationship.
Right.
So a lot of people are concerned about having maturities on their bonds so far out that as soon as interest rates do pop, they're going to be more interest rate sensitive, and you're going to lose a lot of the principal value on those bonds. Now, if you're holding to maturity, you really don't have anything to worry about. You're still going to get that amount back at the maturity date.
Yeah, you can also avoid some of the interest rate risk with the new floating rate bonds that the Treasury's put out. They basically reprice. It's a bit of a complicated concept, but they reprice when interest rates go up, and you get the benefit of the new higher interest rate. You also have the risk of inflation.
Sure. So that kind of eats into the yield that you actually realize. You may have a yield on a bond of 3%, but if inflation is 2%, your real rate of return on that bond is only 1%. Inflation's eating a good portion of that return.
Right. And if inflation were to kick up beyond that 3%, you're not going to get the adjustment unless you have a Treasury inflation-protected security or a Series I bond if you're buying them direct.
Mm-hmm.
So they do have some securities that'll adjust with inflation.
Nick, as our head fixed income trader, how have we tried to counteract the risks of a rising rate environment?
So the best thing we can recommend you do is you stay short on your maturities. Right now, we're not purchasing anything further out than 5 years because you're going to be less interest rate sensitive at that point. You want to keep your maturities, your duration short, so you're not as sensitive to interest rate movements.
Right, and a lot of times, in most cases, we buy yield to maturity anyway, so we're going to hold the bond to maturity, and we know what price we'll get at the end.
Right.